In today's video, I'm going to be reviewing an ETF that pays a 14% distribution rate every single year, and it's also one of the most tax-efficient ETFs on the market at that income level by a pretty significant margin. I'm going to walk through exactly how this fund works, how it generates that 14%, and go over how its structure might make it one of the smartest monthly income ETFs you can own in a taxable account right now. This video is for anyone building monthly income, and especially for anyone in a higher tax bracket who's tired of paying ordinary income rates on their dividend ETFs. Now, full disclosure up front, I do own this ETF in my portfolio, and you can see my entire ETF portfolio on Blossom Social with the link in the description. And I'll tell you exactly why I own this ETF at the end of the video. Now let's go over one of the fastest growing ETFs on the market today. This fund is QQQI, and it's the NEOS Nasdaq-100 High Income ETF. It's issued by NEOS Investments, a firm that specializes in options-based income ETFs. This fund launched on January 29th, 2024, so it has about 2 years of history behind it. It currently holds $10.7 billion in AUM, which is massive growth for a fund that's only been around this long. The expense ratio, which is the cost of owning such a fund, is 68 basis points, which if you reference my chart here, 68 basis points fits in the average range of what expense ratios should look like for option ETFs. Now, this fund holds roughly 105 names, pays a distribution every single month, and it tracks the Nasdaq-100 pretty closely with an active options overlay layered on top of it. Now, one thing worth mentioning right out of the gate is QQQI actually won the best new active ETF at the 2025 ETF.com awards. That award beat out popular issuers like Vanguard, Fidelity, and Calamos. Now let's go over the top holdings. And if you're familiar with the Nasdaq-100 at all, QQQI's top holdings are going to look very familiar to you. Of course, Nvidia's at the top position with roughly 8% weighting. This is the company that's driving the entire AI infrastructure build out. Apple is next at roughly 7%, still the world's most valuable consumer tech company. And of course, there's the rest of them, which is Google, Microsoft, Amazon, Meta, Tesla, and Walmart. So structurally, you're getting very identical exposure to the Nasdaq-100, but the difference with QQQI is that on top of owning these stocks, the fund is systematically selling call options on the Nasdaq-100 index itself to generate the income that gets distributed to you, the investor, every single month. Over the past year, QQQI's total return, which includes income, is 40.2%, which is ahead of JEPQ and other popular cover call ETFs on the Nasdaq-100. Now, since inception of January of 2024, if you have put $10,000 into this ETF and reinvested every distribution, your position would be worth roughly $14,716 today. That's a 40% total return, or about 19% on an annualized basis. If you took the cash instead of reinvesting, you'd still be sitting at $14,015 with $16 per share in distributions collected along the way. And if you actually break down those distributions monthly, here's what 2025 looked like for QQQI investors. As you can see, there's 12 distributions, which is every single month of the year, ranging from about 53 cents to 64 cents per share. The fund has been remarkably consistent with no skipped months or massive drops in income. But now here's the criticism you hear about QQQI all the time, and that this fund suffers from NAV erosion or low price performance. The idea of that is because QQQI pays out so much in distributions every month, the share price slowly bleeds over time, and investors end up worse off than they would be in a simpler fund. And yes, that criticism is half true. QQQI's share price has grown only about 8% since inception, which is notably lower than something like QQQ itself. But once you add the distributions back into the equation, the total return story is actually competitive with or better than most alternatives. If you're getting any value out of this video, go ahead and hit the subscribe button, please. I break down ETFs like this every single week. Now let's get to the part that actually matters most with QQQI, and this is the tax structure. This is the reason why QQQI is worth paying that 68 basis point expense ratio. QQQI's 30-day SEC yield is 0.06%, but its actual distribution rate is roughly 14%. That massive gap exists because SEC yield only counts what the fund technically earns as investment income, which is dividends from stocks and interest from cash. It specifically doesn't include income from selling options contracts, which is where essentially all of QQQI's yield actually comes from. So here's actually what's happening under the hood. Now QQQI isn't generating its yield from stock dividends because the Nasdaq-100 doesn't pay much in dividends to begin with. Instead, the fund is running an active call option strategy on the NDX, which is the Nasdaq-100 index, selling and buying options every single month to collect premium income while still leaving some room to upside when markets rally. Now, those NDX options qualify as what the IRS calls a Section 1256 contract, and that classification is where the entire tax story begins. Under Section 1256, any gains on those index options get taxed at a blended rate, which is a 60% at long-term capital gains rate and a 40% at short-term rates, regardless of how long the fund's actually held those contracts. That alone is a big advantage over most covered call funds because traditional option strategies, whether that's using equity-linked notes or selling options on individual stocks, generate income that gets taxed as ordinary income at your full marginal rate. And on top of that option strategy, NEOS is also actively harvesting tax losses inside the fund throughout the year, which is another layer of tax efficiency that most passive covered call ETFs simply cannot offer. But here's where it really gets interesting. There's another IRS classification called return of capital, or ROC, which is essentially when a fund's distributions are treated as you getting your own invested money back, instead of being treated as taxable income. Now, according to IRS Form 8937 that NEOS officially filed for its fiscal year 2025, 99.6% of QQQI's distributions that year were classified as return of capital. What return of capital means in practice is that the IRS doesn't treat those distributions as taxable income in the year you receive them. Instead, you're getting your own invested capital back on a tax-deferred basis, with your cost being reduced a little bit each time you receive a distribution. Now, at some point when you sell your shares after holding for more than a year, you do pay long-term capital gains tax on the reduced basis, which for most investors sits at 15% or 20%, meaningfully lower than their ordinary income rates. Now, the tiny remaining sliver of distributions that is not classified as return of capital gets that 60-40 treatment, which is also more favorable than ordinary income. Putting it all together, what you have is a fund that can effectively let you compound a 14% distribution rate with minimal tax drag every year you hold it, deferring the bulk of the tax bill until you eventually sell the ETF. Now, in a taxable brokerage account at a high tax bracket, that structure is generally hard to beat. So now here's my personal take on QQQI. Now, the first reason it's great in my book is the tax efficiency is best in class for its category in a taxable account at a higher income bracket. That 99.6% return of capital structure is worth significantly more than that 68 basis points that it's cost you to own it. Second reason is because the total return data generally surprised me. Everyone warns about NAV erosion with high yield income ETFs, and for a lot of funds that warning is valid. But when I actually ran the math on QQQI since inception, the total return has held up well, and the fund has been competitive with lower yielding alternatives such as JEPQ. Now, one reason I would hesitate is the fund is only 2 years old. It hasn't really been stress tested enough through a real bear market yet, and the April 2026 correction is the closest we've gotten to seeing how it behaves under pressure. Now, the second reason I hesitate is covered call strategies cap your upside, but don't really protect you on the downside. So if the Nasdaq rallies hard in a given year, QQQI won't keep up with QQQ, but if the Nasdaq drops hard, QQQI drops nearly as much as QQQ. So you're trading that growth potential for income, not trading risk for income, and that's a trade-off worth understanding before you buy. So here you're trading growth potential for income. You're not trading risk for income, and that's a trade-off worth understanding before you buy. So now who should buy this fund? This is for people who are looking to buy this fund in a taxable brokerage account, especially those in a higher tax bracket who want tech exposure with real cash flow and don't want to pay ordinary income taxes on every single distribution. So now who shouldn't buy this? This is anyone who is looking to max out growth potential. As I mentioned before, this fund has a cap to the upside, but bears the same downside risk. Just keep that in mind before you make it a core important holding into your portfolio. And number two, someone who's holding this fund inside of an IRA, a Roth, or a 401k, because the entire tax advantage of QQQI disappears years when nothing is taxable to begin with. And that 68 basis point expense ratio becomes a bit harder to justify. Now, yes, I do own QQQI. It's about 2.5% of my portfolio, and it's held in a taxable brokerage account, which is exactly the type of account that this fund was built for. And I added it there because the after-tax math makes sense for my specific situation. I treat it as idle cash in my, in quotes, Fidelity savings account, and it provides a yield much higher than a money market does. Let me know what you guys think and drop a comment below. Do you own QQQI? Are you thinking about buying it, or are you sticking with something like a JEPQ, QYLD, or any other alternatives? Let me know what ETF you want me to break down next in the comments below. Newsletter is linked in the description as well. Thank you once again, and I'll see you in the next video.